Hi, it's Edward, back with another video. Please take a moment to click the thumbs up button below and consider subscribing to the channel. Thank you for your support. Today, I read several financial news articles. I'll include links to the articles in the description below. I encourage you to read the articles to support the authors and news sources. As a private American citizen, I like to report and share my transformative thoughts through commentary regarding small sections of these articles that are of public interest. I read an article on CNBC.com written by Brian Evans and Lisa Kalai Han, titled, "Dow Drops More Than 350 Points to End Brutal Week. S&P 500 Closes in Correction Territory." According to the article, the Dow Jones Industrial Average slipped more than 350 points on Friday, capping off a sour week that also saw the S&P 500 enter correction territory. The article goes on to indicate the decline in key tech stocks pushed the NASDAQ into correction territory after falling more than 10% from its closing high in July on Wednesday. This week also saw the index record its worst trading day since February. Here are my thoughts. How deep will this correction be? Could this potentially snowball out of control? For many retired people, they rely on investment returns in order to sustain themselves. This has to be very nerve-wracking for individuals like this. It's too bad that many individuals rely on the Wall Street casino for their retirement, since pensions are rarely available anymore. People with a pension check for life are truly blessed. How many people do you know who receive a lifetime pension? I know a lot of these people, and they don't have the same worries as individuals who rely on their investment returns. One of my retired friends who receives a lifetime pension really enjoys life. He spends freely each week, and he does not have the same stresses in his life that some of his other friends have who rely on Wall Street returns in order to sustain themselves. For me, I am not worried about this stock market correction. I maintain a long-term investment horizon, and I keep dollar cost averaging into investments. Please keep in mind, this is not investment advice. I'm just some guy on YouTube. I also don't have all of my net worth in equity positions. I read an article today on Yahoo Finance written by Rita Nazareth titled, "War Fears Drive Gold and Oil Higher. S&P 500 Drops. Market Wrap." This article was put out by Bloomberg. According to the article, oil topped $85 and gold hit $2,000 amid the latest geopolitical developments. This may be good news for individuals who own physical gold. I, for one, own a lot of physical gold and silver. For me, it's an insurance policy. If there ever is something that is severe in our world, like a currency crisis or something that disrupts the economies around the world, I sleep well at night knowing that I have physical gold and silver. I simply like owning something that is tangible. I like silver and gold because they have had value for thousands of years. I plan to continue purchasing silver and gold into the foreseeable future. I read another article today on Yahoo Finance written by Eleanor Pringle titled, "U.S. Consumers Are Walking Towards a Cliff and the Jobs Market is Beginning to Fray at the Edges," warns market strategist. This article was put out by Fortune. According to the article, Americans are hurting, and one market strategist believes life might be about to get a whole lot worse. Longview Economics founder Chris Watling argues U.S. households are walking towards a cliff, basically, and warned the excitement around strong retail sales is not justified. That poses a problem for U.S. growth, as spending by consumers accounts for over 2/3 of the economy. He says they're running out of cash. If you look at excess savings, they've been run down quite hard. It's scary to me that consumer spending makes up approximately 70% of GDP in our country. Now that interest rates are in the mid-20s to the low 30% range, this is problematic for people who rely on credit cards to keep spending. This debt is going to snowball out of control for many everyday Americans. How long can the consumer continue to spend, especially in this higher interest rate environment? This article goes on to reference Bill Gross, the bond king, who is similarly unconvinced by the seemingly positive picture some data sets are painting. According to Bill Gross, the U.S. equity market is too expensive. It's overvalued. The U.S. in aggregate is overvalued. Tech's overvalued. I think the U.S. is in for tough times. I couldn't agree more with Bill Gross. There has been too much optimism surrounding artificial intelligence, in my opinion. If some of these high-flying stocks start to deflate further, this could potentially result in layoffs. This is problematic from my perspective because many everyday Americans don't have any emergency savings, and too many people have grown comfortable during the past decade and a half when money was cheap and easy. I read another article today on Yahoo Finance written by Sarah Lewis titled "America is Now Paying More in Gross Interest on its Record $33 trillion in debt than our national defense. Who holds the IOUs?" This article was put out by MoneyWise. According to this article, much of the borrowing in the past couple of years happened while interest rates were historically low. But now that they're not, with prices still climbing, the cost of this debt will be amplified. Nearly $2 billion is spent every day just in interest on the national debt, according to the Peter G. Peterson Foundation. What in the world is happening in America? You could lose sleep thinking about this situation. What's scary to me is what I just read to you is so similar to what is happening with American households who have credit card debt. Many American households accumulated this credit card debt when interest rates were lower. And now that the Federal Reserve has hiked their Fed funds rate 11 times, these individuals are having to deal with much higher interest rates on their credit card debt, making it more difficult to service this debt month after month after month. At what point is this no longer sustainable for the everyday Americans who are dealing with this credit card debt? I read another interesting article today on seekingalpha.com written by Liz Kishi titled "Capital One Credit Card Delinquency Rate Rises. Write-off Rate Falls in September." According to this article, Capital One Financial saw its credit card delinquency rate rise in September. I am not surprised by this at all. Many everyday American consumers are tapped out financially. Credit cards were the last resort to be able to bridge the gap between what these everyday people are bringing home in their paycheck and what their expenses are on a monthly basis. With sky-high interest rates, using credit cards to survive is getting more and more expensive every day. This can only go on so long, in my opinion. Eventually, many everyday Americans are going to have to cut their standard of living dramatically, and they may also have to look for additional employment to bring in extra money just to sustain themselves. How many everyday Americans do you think are prepared for this reality? At times, I feel as though people have been living like it was the Roaring '20s, leading up to the 1929 crash, and we all know how that ended. I read another article today on CNBC.com written by Nicholas Vega titled "Taylor Swift has reportedly entered her billionaire era with success of the Eras Tour." According to the article, the 33-year-old's net worth is now roughly $1.1 billion. The Bloomberg News analysis found to calculate the figure, which the publication called conservative, it estimated the value of her 5 homes, earnings from music sales, streaming deals, concert tickets, and merchandise, as well as the value of her music catalog. I'm happy for Taylor Swift. From what I know about her, she seems as though she is a very hard-working entertainer. I know she has a lot of loyal fans. Just keep in mind, this wealth came from all of her loyal fans, many of whom likely had to rely on credit in order to purchase her concert tickets or tickets to her movie. I have no doubt that some of her fans are wrestling with credit card debt right now because they were living in the now and just had to purchase those Taylor Swift tickets with no consideration for how they would pay off that debt later. I am sure some of these Taylor Swift fans who used credit to purchase these tickets have no emergency fund and little to no retirement savings, yet they went out and spent money for these entertainment experiences. Another article that I read today, which I would like to share with you, came from CNBC, written by Melissa Repko, titled, "A Credit Card Christmas. Taking on shopping debt carries more risk this holiday season." According to the article, the holiday season shoppers who ring up purchases on credit cards will pay more interest if they carry balances from month to month after the Federal Reserve's string of interest rate hikes. The cost of borrowing has climbed as credit card delinquencies have ticked up, though the metric remains below the highs of the Great Recession. In addition, student loan payments have resumed after more than 3 years of a pandemic-related pause, adding to the debt that many Americans are trying to pay off. So, credit card delinquencies are still below the highs from the Great Recession. I don't think that this is something to brag about. The Great Recession was a financial tsunami that impacted the entire world. The Great Recession was only second to the Great Depression in terms of how bad it was. With the crazy interest being charged on credit cards right now, and the fact that many everyday Americans are struggling with inflation everywhere that they look, I certainly think it is possible that credit card delinquency rates at some point could potentially surpass Great Recession highs. I could be completely off base here, but consider everything that is going on in our economy. Home prices are sky high. Apartment rent is sky high. Every time Americans go to the grocery store, they get sticker shock. Many everyday Americans are stretched thin financially and relying more and more heavily on credit cards, which they are unable to pay off at the end of the billing cycle. Many continue to roll this debt over month after month after month. With the high levels of interest being charged, this may not be sustainable for some households. This article also references student loan payments resuming. Well, we still don't know how this is all going to shake out. One thing is clear though, this will likely have some impact on consumer discretionary spending in our country. I think this really could impact many facets of our economy. Here's another interesting article that I read today on Yahoo Finance, written by Alicia Warren, titled, "Fed's Interest Rate Decisions Destroyed Commercial Real Estate Market, Expert Warns." This article was put out by Fox Business. The article references Don Pebbles, chairman and CEO of the Pebbles Corporation. I'll quote him as saying, "Anyone who has bought an office building in the last market cycle has problems, or problems are waiting to happen." He goes on to say anyone who bought an apartment building at a 3.5% cap will also encounter problems. He says the problems are so big that lenders have to hope and pray that things get better. In my opinion, hoping and praying isn't going to fix anything. This is a real problem. I wonder how exposed the banks are to these potentially bad loans. Keep in mind, commercial properties and apartment complexes are large and expensive real estate assets. We're not talking about small single-family homes here. We are talking about some very expensive real estate. Here's the problem from my perspective. Many of the individuals who went out and purchased this very expensive real estate did so with short duration loans with long-term amortizations. They now are getting to the point where they have to refinance in a higher interest rate environment, and for some, the cash flow model no longer makes sense. They may not be able to refinance in this higher interest rate environment. Some of these banks may be forced to foreclose, and this is very problematic because what are these banks going to do with these properties? They will then have to make the payments for high property taxes, insurance, utilities, maintenance, etc. This could potentially crush some of these financial institutions who are holding this bad paper. Here's another interesting article that I read today on Yahoo Finance, written by Janine Mancini. It was titled, "Buyers Must Earn $115,000 Annually to Qualify for a Typical Home in the U.S., which is $40,000 more than the average income." This article was put out by Benzinga. According to the article, a typical home buyer now needs an income of $114,627 to afford a median-priced home in the U.S., a 15% or $15,285 increase from a year ago, and a 50% jump from the start of the pandemic, according to Redfin data. The article goes on to indicate as monthly mortgage payments hit an all-time high of $2,866, up 20% from $2,395 a year earlier, the financial gap between the typical American household's income and the income required to buy a home grows wider. In my opinion, this is what happens when trillions of dollars are printed out of thin air. This is what happens when you juice the equity markets. This is what happens when people get addicted to the Zillow app on their phone and think they're rich because their home price keeps going up. This is also what happens when the herd mentality runs wild and a multiple offer mania is put into motion. Lastly, this is what happens when money is cheap and easy for far too long and Wall Street companies are able to speculate and turn homes into speculative assets and drive prices to crazy highs. I'll share another interesting article with you that I read today from Yahoo Finance, written by Adam Clark. Apple stock is struggling on iPhone gloom. Now it faces another device headache. This article was put out by Barron's. According to the article, Apple stock is having a rough couple of months with doubts about demand for its new iPhone. The mood is unlikely to be lightened by news it faces a potential ban on imports of certain models of its Apple Watch. In my opinion, this may not be good news for investors. If you have a retirement account, some of your funds likely have Apple stock in them. In my opinion, Apple has been too slow to innovate in recent years. Some of the Chinese phone manufacturers are light years ahead of Apple, not necessarily from a quality standpoint, but in terms of technology innovation. I continue to see titanium Apple advertisements everywhere. I don't think many everyday Americans care about the metal used to manufacture their phones as much as they care about shiny new colors. I personally think Apple is taking the wrong approach when it comes to marketing these new devices to consumers. I personally think titanium is an amazing metal. It was used to manufacture the SR-71 Blackbird, which was the fastest spy plane of all time. When the SR-71 Blackbird was being manufactured, the company had to figure out ways to work with titanium. They had to come up with new equipment in order to machine titanium. Don't get me wrong, I think it is cool that Apple is manufacturing its phones out of titanium. I just don't think this is something that resonates with many everyday Americans. What do you think about all this? Share your thoughts in the comment section below. Please keep in mind, nothing in this video is financial advice. If you need advice of any kind, seek advice from a qualified professional in good standing who puts your interests first and foremost. If you enjoyed this video, consider giving it a thumbs up. If you haven't yet subscribed, please consider doing so. I want to extend a special thanks to everyone who has subscribed to this channel. I also want to thank all of my channel members. Stay healthy and wealthy. I'll see everyone in the next video.